And concurrent with that was also this sort of move on a political level to get rid of a lot of the financial regulations that maintained, that also sort of kept their business separate from commercial banks. The Glass-Steagall was repealed, pushed by Bob Rubin,
who was the former Goldman chief,
Phil Gramm, and of course signed by Bill Clinton. All right, but let's talk now specifically about the tech bubble. How did they drive the tech bubble, and how did they profit from inflating it and its deflation?
Well, first of all, before even Glass-Steagall happened, before there were deregulatory changes, legal changes, there were changes in the standards that investment banks like Wall Street operated by. It used to be that when you took a company public, and Goldman was the king of the initial public offering, they took Ford Motors public. They were considered the leaders in that area of investment banking business. It used to be that when you took a company public, the company had to exist for 5 years, it had to have been profitable for 3 years, it had to be making money at the time of the IPO, and it had to be projected to be profitable in the near future. And what happened was, sometime in the mid-90s, a lot of these companies completely dropped those standards, and Goldman was one of them. They started taking companies public that had no history whatsoever, that had been in existence for minutes, maybe at best. And this was all of these internet IPOs that you saw happening in the late 90s involved companies that had little or no history, that weren't projected to be profitable in the near future, that had never made money. And what happened was, a lot of people who trusted these banks to have some kind of standard, they weren't aware that these standards had disappeared, and a lot of people were sort of snookered into investing into these companies. So that's the major thing that happened with the internet business. Goldman was the #1 underwriter of internet companies. By the height of the boom, 1 out of every 5 internet companies that was taken public by Goldman Sachs. In 1999, they took, I believe, 37 internet companies public. And it raised an enormous amount of money, but really the only people who made money were the people who cashed out early, and that was Goldman, that was their insider clients, and the executives of the companies that they took public. Everybody else took a bath.
Yeah, you basically talk about there's 2 tier of investors in this. The ones that understood that you got to get in and get out, and then everybody else who thought, oh wow, these things are getting huge, and I got to get a piece of it. I was one of the second group. Fortunately, I didn't have that much money to lose. But so they basically, this is, you call it a big pump and dump scheme, which is basically they inflated the value of these things, in addition to bringing companies public that shouldn't have otherwise gone public. They inflated the value of it by.
Well, there were several different methods. They were caught on numerous occasions. They were sued on numerous occasions by shareholders for a variety of practices. One of them was called laddering. Laddering was a scheme by which you promise your favored clients that they can buy shares in a new company at a low price in exchange for a promise that they will come back when the price comes up and put more money into the company. And this artificially inflates the value of the company. Say you go to your client and you say, okay, we'll sell it to you at 16. You come in and you buy 1 million shares at 16, but when it hits 24, you got to come in and buy again. So if you have enough of these people, now that means that a few insiders, including of course Goldman Sachs, knows that when that stock hits 24, that it's going to go back up again. So they're aware that the stock is going to reach a point, it's going to continue to go up. That means they have insider knowledge about when it's likely to go down too, and when you probably should cash out. They know it's going to go up here. They know that rise is probably a false rise, so they know that they should probably get out shortly afterwards. And that's what happened. A lot of these.
I could make money. With that type of knowledge.
Right, exactly. I mean, you don't have to be a genius on Wall Street to make money if you know what's going to happen.
Obviously, there were other factors that led to the tech bubble. I mean, the whole notion that, well, companies don't need to make money because all the value is yet to be realized. We're just going to create this infrastructure online, and somebody's going to come in and figure out how to make money off it. So they're not the only thing, but they had a huge part of it.
That was a significant factor. There was another practice they engaged in quite often, which is called spinning, which is where you promise. Usually, it was actually the executives of the company that was taken public. You promise them that they can buy shares in the company at a low price in exchange for future underwriting business coming to Goldman Sachs. So in other words, I take your company public and I say, hey, you can buy at 16, but next time you need underwriting business, you have to come to Goldman Sachs. Now, the reason that this is bad is because normally when you offer somebody the opportunity to buy at a low price, you should be offering the company the opportunity to buy at a low price, not the executives of that company. So this was actually robbing the companies of money that they should have been entitled to, and instead the money went straight to the executives.
Well, I think in other businesses, like let's say the towing business, you call that a kickback.
Right.
I mean, that's what it is.
That's
right?
what it is.
It's
a straight kickback, and initially it artificially jacks up the price of the company, but in the long term, it actually robs the company of value.
Because those are dollars that they're not going to get, that are going to go into someone's pocket.
Right, and what's most important about that is that this is a cynical admission by all the insiders in the game that they know that the way you're going to make money in this whole venture is in the short term. If everyone is trying to get money in that initial period, that means that they know that the game isn't staying in for the long haul.
Right. Now, did they make any money as this whole thing collapsed, or was it just they had made their money? Now move on to
Goldman made in the year of the crash in 2002. Goldman made they paid out $6.7 billion in bonuses and compensation, which was only slightly less than the year before. So they made enormous profits throughout this entire debacle, and they made it money going in. They made it money going out.